Okay, so now we move on to the much anticipated market, which is Nestlé China. I'll start with setting 4 themes. Look, Chinese market has slowed down, but I will say, and we will tell you, we still believe it's a great consumer story. Clearly, many evolving consumer needs. The channel dynamics are also changing and evolving. And what are the implications for Nestlé? So let me take you through, set the scene first, and then we'll talk about Nestlé in China. What is the new China, the China new normal? Everybody knows this, slower GDP growth rate. It's now at 6%, between 6 to 7. Structurally, they're shifting from investment to consumption. And really the driving force of growth will be technology. That is that is what coming out of the Chinese establishment. So the implications for companies like Nestlé and just FMCG in general is top line growth will be slower than before. And we have to build new competencies in terms of dealing with new channels like e-com instead of the traditional bricks and mortar. And not only does it have implications from a top-line perspective, it clearly also has implications from a bottom-line perspective. We have to manage our costs a lot tighter. Logistics cost is going up, labor cost is going up, and also when you don't have the kind of growth that we used to see, you can't leverage growth as well as we used to do. Embracing new technologies not just as a way to engage with consumers and to work with the trade, but also embracing technologies in order to improve our own efficiency. And again, this is such an important point. Even before all these massive changes in China, it's always been a challenge in making sure we develop talent locally and that we get. But now it's even more challenging because not only are you building talent for your own Chinese business, but now you're building talent for these new capabilities that is needed in order to succeed in China. So just a quick look at overall FMCG growth in the last few years, starting in 2011. And you can see here that the trend clearly is downward. And then the bit of a spike there that you see is really actually personal care and home care, rebounded in Q4 of 2014, as well as in H1 of 2015. And that's mainly due to growth in skincare. But China remains one of the best consumer stories in the world, and why is that? You can see on this slide, fast growth of middle class and upper middle class. It's CAGR of 27%, 17% in the top 3 household income segment. And not only that, the disposable income growth is still growing well above inflation. So still a lot of room to grow. But Chinese urban consumers are affected by so many things. It's a new generation of Chinese consumers. And in many ways, China is more advanced in digital, I think because one reason is because underdeveloped traditional trade, especially in lower tier cities. But also mobile phone is incredibly inexpensive and it's so accessible. So you see many of the apps on mobile phones have such high penetration. And the size of the price, there's so many, I often hear and meet VCs who are in China because the size of the price is incredibly high. There are 300 million consumers in the US and there's over 1 billion in China. If you innovate and you come up with a product that works, whether it's an app or it's very, very, the size of the price is 4 times bigger than that of the US. 4 to 5 times. But one thing is for sure, over the last 10 years, we have witnessed the Chinese market becoming one of the most sophisticated markets in the world. It's interesting, I was comparing notes with my colleagues, and in the group, no offense to any of our great talents running any of our other businesses, China for us in Nestlé is one of the toughest markets to manage. Not only are you dealing with very fast evolving Chinese consumers, the trade dynamics is changing, but then we also have 3 big JVs that we have to manage. But this change, and on top of that, you've seen my chart earlier. E-com is growing really fast. This notion of infinite shelf space. Some website has 1 billion offerings And so what are the implications when you think about a company like ours? All of a sudden, a consumer has just many, many assortments to choose from, and it's infinite price transparency. And so, so you see shoppers are affected on so many, many fronts. I talked about this. Consumers in China are embracing digital much faster. You start this circle with the discovery. Over 75% of customers use internet or for browse or purchase. Then they discuss 700 million users are active monthly users combined on WeChat. So they get on and discuss on what to buy. 2 times more satisfied on e-channel versus offline is what the consumers in China are telling us. Over 50% of purchase decisions are made online. It's like over 12 trillion renminbi of online or mobile payments. And then they share. It's like 80% of shoppers give reviews online. It's, it's just like I have to make myself whenever I buy something and I have to go make a review. But they do. They're just so engaged. And so the Chinese consumers are embracing digital definitely much faster than their counterparts in other developed markets. And so what are we seeing in terms of digital providers? BAT is Baidu, Alibaba, and Tencent. BAT is, there's a very intense focus on building a holistic ecosystem. And so you see this chart on what the different players are doing in terms of alliances, joint ventures, in terms of outright acquisition to buy capabilities. It's either from content to transaction to consumer engagement, this O2O, which is online to offline. It changes, it really has profound impact on how consumers engage and how consumers buy, but it also has profound impact on the way we do business. Digital is permeating many aspects of consumers' lives as well as of businesses. And so many of these players are sitting on tremendous data information. Another change in the Chinese landscape is this the trade model shifting from push to pull. I think many of you heard from us as well as from other FMCG companies on how a few years ago we found ourselves sitting onto a lot of inventories and having to go through a process of destocking. The model for the last 20 years, and this is not just, this is everybody did that. It was almost like land grabbing, right? Get the distributors, you rely on a push model, it's multi-layer distributors, sub-distributors, wholesalers, and then you have lack of visibility. But that is changing to a demand model where your portfolio of products have to really, really resonate with the local consumer. Then you have to make sure you've got the right products, the right brand, and execute it really well, whether it's in store in bricks and mortar or on the landing page on the digital store. So clearly that's another dimension that we, just like other companies, have to cope with. So now let me switch gear from sort of like China in general to Nestlé Greater China region. We're competing across 10 categories. Nestlé in China in GCR is 7 billion Swiss francs, and 42% is globally managed, and 58% is Nestlé FMB. Now the largest GMBs are Nestlé Nutrition and Nestlé Professional. For us, we have 35 factories for R&D, and we have 52,000 colleagues or employees covering 1.6 million outlets today. It's like the numbers are mind-boggling. But let me now focus on the 58%, the Nestlé F&B, which is obviously within the scope of Zone AOA. So let me peel the onion and say, okay, our F&B sales in Greater China region is 4.1 billion. Now, on the left, which is other categories, and this is coffee, and I want to give a sense of like what are the categories that are doing well or have stabilized, and what remains a challenge, which is, surprise, surprise, Yinlu. Coffee is definitely in the green zone. It's very, very happy with how we've what we have done there. And confectionery also, and that includes both Shark and Shu Fu Chi. Culinary, that's mainly Tai Tai Le. And dairy and ice cream, I put a red. We were debating yesterday amongst the team. I said, no, it's a red. because my team was saying, oh, maybe it's a yellow. I said, no, it's a red. I'm not happy with our dairy business in F&B. So let me now, and in terms of Yinlu, and it's okay. Peanut milk and congee obviously represent a big chunk of the Yinlu business, but not everything is bad. In fact, the RTD coffee is growing at 30%, and we're really happy with that. But the challenge with that is, the RTD coffee is not big enough. As the congee and core peanut milk goes down, it's not big enough to try to offset what's happening on that side. So let me start with the left side, which is coffee, confectionery. So let me start with that. And again, China, no different than all our other markets. It's really understanding consumer insights and refreshing the products. So with that, reconnecting with consumers through premiumization. Nescafé Dolce Gusto has grown nicely, but I always challenge my team, and don't tell me about its growth. In the last so many years, grew 9%. I said, well, 9% of a small base is still very small. So I personally am not happy with it, but look, it's still good growth, but it's a key pillar in terms of our coffee premiumization. Confectionery premiumization is also key for maintaining our growth and market share gain trajectory in confectionery. We launched Kit Kat last year. It was well received. We will continue to roll out Kit Kat. We premiumize, popular products like Sashima. It's the milk candy. It's the shortcake, and have the Chinese New Year, this past Chinese New Year, it was really good to see in terms of execution and shopping experience. It was better than any other years before. In terms of winning consumers, aside from premiumization, we've launched new products, and that has helped Nescafé in terms of the importance of shifting trends, making changes in various fronts. Today, we're number one. With 74% share and 100% with 60-40 win. When you look at Shark and Shu Fuji, same thing. We're targeting young people for Shark, and number one with 32% share. And Tai Tai Lo, which was a JV we bought many, many years ago, is also doing very well. We, by the way, in April of 2016, we bought out the remaining 20% of Tai Tai Le from Mr. Rong, who was the founder CEO. But in order to ensure a successful transition, Mr. Rong is staying there until for 2 years until a new CEO is identified. Deeper penetration and wider coverage. Nescafé, I talked about this before. That's a ready-to-drink Nescafé Smooth Latte, and this is the one that's growing close to 30%. We see great potential for this product. And Tai Tai Le also, we are rolling it out to out-of-home markets and penetrating lower-tier markets. In terms of e-com, it's again more than doubled in 2015. And this is, again, a constant debate between the China team and myself, because I'm not happy when we look at, I should be happy because it's high percentages, but still, with the kind of acceleration that we're seeing in China, growing at even high double digits just is not good enough. So, but I guess I should give credit where credit is due. They are doing a nice job. They just have to go a bit faster. This is just a, in order to kickstart, we have a strategy in place in terms of e-com. To kickstart the Alibaba Nestle partnership, we are doing a super brand day to sort of like celebrate 150 years with Nestle. It is, this will see quite a few first time in China that the Nestle Group is holding a joint event cutting across the entire categories within the Nestle Group. We will have 27 brands and 154 products, 50% domestic, 50% international. It's the first time that Alibaba Tmall is holding a promotion of such magnitude, cutting across 13 Tmall stores. It's the first time that an FMCG company in China is using virtual reality technology for communication. We're partnering with Youku, which is the YouTube equivalent. It's amazing. I look at the numbers, and this VR program will be in a pre-roll for the top 2 programs on Youku. And I was looking at the numbers in 2015. This top program, which has like the top 5 male actors in China, had, in 2015, 2 billion views. That's a B. That's billion with a B. So it's like the numbers are just mind-boggling. So we're excited about this. We'll see, but clearly it's to accelerate. So now comes Yinlu. Let me now talk about Yinlu. We it's what I call it's a business in transition. Yinlu has been, well, before I start, maybe I should pause and make it very clear that as disappointing and as frustrating as the results have been for Yinlu, we firmly believe that Yinlu provides us with a unique platform that's critically important for China, which is the ready-to-drink. It's a category that's growing very, very fast in China. As I said, our RTD Smooth Latte grew close to 30% in 2015. So this is not, we're a firm believer in this platform. We just have to make it, get it back on track. So Yinlu has been a very successful business. It's a traditional model. It's profitable, the #1 plant protein drink, nationwide distribution, 2,000 tier 1 distributors, extensive store coverage, but as I said before, very much relying on a push model. But in times like this, a few things happen. It's sort of like a perfect storm with several factors coming into play. The core peanut milk range has been declining, and it's consumers are shifting to more premium products, and we haven't been fast enough in premiumizing it. And also, with the collapse of milk prices, people have the consumption of dairy has picked up at the expense of sort of like peanut milk consumption. And what has taken us a few months or some time to realize is we've been so focused on refreshing the portfolio, making sure, repositioning the product. But what we found out in the last few months is when a product is not working as well with consumers, you start to have sort of like this spiral down effect with distributors. The economics don't work so well in distributors. You start to have churn in your distributor network. Your sales force starts to churn. So it's just sort of like, a whole host of things just started to happen. We have a very comprehensive turnaround plan in place. First and foremost, I talked about this, we are upgrading existing products to make sure that it's on trend in terms of what people want to drink, healthier choices, a more premium instead of peanut milk, going to walnut, going to almond drink. We're also accelerating new product development. Milo is now in the trade. Early days tell us that it's very well received. We're launching Shakissimo, which is the shelf-stable version of Shakissimo that you see in Europe. It's a fantastic product. It's a premium product. So we'll see. We are, and again, what we're we'll see. But we're working very closely with the local team. We obviously have to change the route to market and moving towards a pull model. If you have better products that resonates with the consumers, then the pull will naturally come. But in the meantime, we're working with the distributors to make sure the economics continue to work for them as we transition to a pull model, and then making sure we have strong execution. It's interesting. We have put in a new. This is a 60% owned business, and I have tremendous respect for the CEO founder Chen Qinsui, and he will be looking at transitioning. So we're working together to make sure that the transition works well, but also we are working, finding ways to collaborate so that the new product launches work better. And so how do you, I always think about this is old days, right? When you have your PCs and I don't know if you remember this notion of you have a sticker that says powered by Intel. And I was telling them that, look, your entrepreneurship works, you go fast, you do this. Why don't you allow Nestlé to kind of power, your entrepreneurship, and let us bring what we do well in R&D, in marketing, and sort of like find a sweet spot that we can work together to make sure that we get this problem fixed sooner than later and bring Yinlu back on track. I will tell you, this transformation, this turnaround will take time. And good news and bad news is, good news is we continue to believe that this is an excellent platform and part of the pillar for us to grow in GCR. Bad news is it's a big business, and so if Yinlu doesn't, as Yinlu goes through the process, and in the next few months, the balance of the year, it slowly comes back on track. It's a big drag on the China business, and China being a big part of the zone, it will also have a drag-on effect on GCR, but on zone AOA. But I continue to be personally I flew to Xiamen a few times. Last year I flew to Delhi 5 or 6 times. This year, my favorite destination is Xiamen in China. But anyway, let me close the China discussion with sort of like 4 key takeaways. China, we believe, is still a great, great consumer story. Nowhere in the world will you find the kind of dynamics. But having said that, it's moving really, really fast. And so you need to have a product portfolio that will be relevant to a very fast evolving Chinese consumer. We need to, and because the trade dynamics is also changing, we need to accelerate digital and commerce. And clearly, we need to turn around Yinlu, turn it around, get it right, and do it sooner than later.